Stocks are starting 2026 with scars from weak growth, policy noise, and corruption scandals. Yet Unicapital believes this could still be a year of recovery. In its latest report, When the Dust Settles, Unicapital sets a 6,800 target for the PSE index, banking on earnings growth, infrastructure resumption, and more accommodative monetary policy. Joining us to break down that call and where they see opportunities is the equity research analyst of Unicapital, Peter Garnace. It's good to see you again, Peter. Welcome back to the program.
Hi, Cathy. Good morning. Thanks for having us.
All right, so let's start with the title. You called this outlook When the Dust Settles. It's quite conditional, but in concrete terms, what is the dust in the Philippine story right now? And what tells you that this year is when conditions stabilize rather than deteriorate further?
Right. I think our title, When the Dust Settles, reflects more of like a market that has gone through governance noise, infrastructure delays, and valuation compression. And it is now moving into more stabilization period. In terms of the macroeconomy, we want to put it this way. The noise has been loud, but the fundamentals are stabilizing. The current situation is more of like a deja vu of the 2011 corruption scandal during the Aquino administration, where infrastructure spending tightened and dragged down the overall economy. But what follows, that is a gradual recovery in the economy, and that's exactly what we are expecting. We do continue to see opportunity.
Your base case has GDP growth recovering toward the mid 5% area this year, and that's because of the resumption of the infra projects and improved policy execution. So what are the two clearest signs then that you're seeing that would support this recovery narrative?
Yeah, right. Our target for the GDP for 2026 is at around 5.2%, and this is actually backed by a 1.3 trillion infrastructure spending of the government to restart and also to improve governance. We do think that policy clarity plus infrastructure spending is a powerful combination. At the same time, we do think that inflation is contained, giving the BSP more room to cut rates, which is a meaningful tailwind for consumption and investments.
So let's say
in the near term, yeah,
right.
Growth may still feel constrained, but the bigger picture is improving.
If those assumptions falter, and it's pretty conditional and nuanced, say infra is delayed again, or maybe confidence doesn't come back, what is the realistic downside band for growth that would force you to revisit the rest of your calls in the report?
Well, yeah, in terms of our index, so we are targeting a base case in terms of the PSEI target at 6,800, and that's largely driven by earnings growth of around 10% or low teens, and a modest re-rating of around 10.5 times PE. Meanwhile, our bear case, this is assuming growth disappoints, inflation resurges, and rates stay higher for longer. We are seeing the index to be at around 6,200. So in terms of our bull case, our target is at around 7,200. So this assumes more rate cuts from the BSP, inflation stays tame, and sentiment improves faster than expected.
Let's
so
take
even
a look
if
at
our
that base
even
case.
in our bull
It's
case,
really interesting that we're seeing a bit of an uptrend there. Taking a look at that green block in the chart, that's exactly where you're expecting the PSCI will be for the full year at 6,800, which really implies low double-digit upside from the close of 2025. So walk us through those key building blocks of that particular number, the earnings growth that you're penciling in and the valuation multiple that you're willing to pay.
Right. More on the base case, we do think that it will be driven by more of a double-digit earnings growth still. We are projecting 10% EPS growth for our base case, and a modest re-rating to 10.5 times PE multiple. But even if at 10.5 times PE, it's still below the historical average of the PSEI. So we do think that at the current valuation of the market, risk reward is still skewed to the upside because we think that the pessimism is already priced in.
If we take a look at the earnings out so far that you're seeing in key industries, maybe from banking to utilities, which sectors do you think are doing the heavy lifting in this earnings story? Is it mainly the banks, consumer, or infra and utilities?
Yeah, we do think that currently utilities utilities have outperformed the rest of its peers, and we are actually overweight on utilities, REITs, and even consumer staples, while we remain selective on the exposure to structural growth opportunities, more on the renewable energy and consumer discretionary.
Well, if we take a look at the policy side and pull up the chart, it's very interesting that you make a mention of monetary conditions as increasingly accommodative, but that kind of environment that would promote this view that you have of 6,800 are implicitly built into the constructive view on equities. So what can you tell us about what we're seeing and where you see rates going to support your view?
Right. Well, in terms of inflation, we forecast inflation to average at around 3.2% this year in 2026, and this is still within the government's target band of 2 to 4%. With inflation being firmly anchored and comfortably within target, the BSP, we believe, has more room to cut rates, probably be another 25 bips in the next in the second half of this year. So this should ease financing costs for both households and corporates alike. So with lower rates, it means a relief for consumers and oxygen for earnings. As borrowing costs come down, consumption and investment should gradually pick up, helping offset the last year's slowdown in public spending.
Well, let's take a look at where that oxygen falls into the stocks that you have. Because you describe your recommended positioning as defensive yet opportunistic, could you just give us one example profile of, say, a defensive name that you like and one structural growth profile that you would buy in pullbacks?
Well, yeah, I think in terms of one of our picks in our dividend basket would be Meralco. It just recently released its earnings, full year earnings, and it actually surpassed its guidance of around 50 billion in core net income. And although this was in line with our expectation, and this is really largely driven by its power generation segment, it has really drove the earnings of Meralco. And we do believe that Meralco do still have some upside opportunities. And as we know, Meralco, everyone needs electricity, consumes electricity, and we do see some drivers still moving forward for the utility company, given that it is really expanding organically and inorganically, given also that it will also energize, or it will roll out more power plants in the upcoming years. So we do like the likes of Meralco, Aboitiz Power, also MWC, Manila Waters, also among our picks, given it is really there's really growth in this stock, given we think that it has opportunity to acquire or to enter into more JVs in the future. Recently, it acquired Wawa JV Co, although it's an affiliate of Manila Water, but we do think that it can also acquire more or enter into partnerships with LGUs to provide bulk water services and even water distribution services. So these stocks, we believe, would be quite defensive. So with with the lingering uncertainties, if volatility stays, income wins. So our dividend basket, just to provide more context, it was built on stability and yield, offering an average of 5.6 yield for 2026. And this is comfortably above the 2-year benchmark rate and heavily weighted towards utility, REITs, and complemented by selected telcos and banks, sectors with visible cash flow and defensive characteristics.
What about the structural growth profile that you'd buy back if indeed there was a pullback?
But yeah, I think in terms of structural growth, we are seeing some names in the banking sector as well as the property sector. We have included RLC as well as China Bank in our dividend portfolio. We do think that with the recovery in the economy, with the cyclical recovery in the economy, these stocks would also benefit from the economic recovery.
And we're just talking about the risks and the opportunities here locally. What about those overseas? Like, say, the biggest risk that you think is most underpriced right now. Do you think it's geopolitics, maybe the trade imbalances, or global rates? Or is it still the corruption noise here and the recovery from that?
Right. We do think that still the lingering uncertainties in terms of the tariffs as well as geopolitics are the main or the key risks that we have to take a look at moving forward. And that's also the reason why we continue to have a defensive stance in the market because we think that in this volatile market, being defensive pays well.
Just as a final point for investors who've been underweight in the Philippines since the last sell-offs, when the dust settles scenario plays out, what do you think they will regret missing out this year?
We think that confidence is the key factor that we are taking a look at, and it has been quite weak for in the past few months, but it is slowly recovering. We think that the recovery will be gradual, and we do actually see foreign funds coming back to the Philippines. And just recently, they have become net buyers to the tune of around 20 billion or around $250 year to date. And this is actually a turnaround compared to over 50 billion pesos in net foreign outflow last year. And we believe that this foreign inflow is largely due to global funds rotating out of the crowded AI trades and more into the undervalued markets like the Philippines with valuation re-rating opportunity. And we see actually this is a sign of the Philippines is entering into the global EM radar screens of our global investors.
All right.
And also, yeah.
In other words, don't miss the boat. Thank you so much for that detailed report. Really appreciate your insights. Peter Garnace of Unicapital Securities.